Good morning, everyone, and welcome to this discussion where we'll be talking about the role of ETFs within your asset allocation for 2025 and beyond. We're delighted to be joined today by Geopolitical from DWS, Antoine Denis from CIS, and Ivan Rodoui from Raiffeisen. Good morning, all.
Good
Just to
morning.
kick things off, Gilles, maybe from quite a high level, it'd be good to hear from you. What are some of the macro and geopolitical events you're looking at over the coming quarters, and how are they sort of influencing client sort of asset allocations?
Surely. So, Jamie, there's quite a lot on the horizon. Obviously, with the US elections on one hand, the geopolitical tensions, there is room for a lot of volatility in the market. There's room for a lot of discussions at index level. There is room for a lot of investors realizing that there are many ways of gaining access to either the equities or the fixed income side, but also new asset classes such as crypto, and themes around AI and further factor and sector rotation.
Great stuff. Ivan, it'd be good to hear from you as well. Similar sort of question. What are those macro and sort of geopolitical events you're watching out for over the sort of coming year or so, and how are those influencing your allocations?
It's great. I think it's always easier to come after Gilles in this kind of situation where not exactly the same as Gilles. It's U.S. elections. That we think it will bring volatility in the markets and uncertainty, and that we can see that in the results. With the results of the expected results of the elections, and then central banks. What's happening? I think there's a lot of things that will happen in the next 3 months or so. It's very interesting, to see what will happen in the future. But it pushes us to be quite conservative.
Yeah, good stuff. Antoine, similar question to you, sort of on the macro geopolitical side. What are some of those key events? Obviously, we've heard about US elections. Are you watching sort of US job prints, central bank sort of rate cuts? Yeah, what's on the sort of horizon for you at the moment?
Yeah, so I think the question is pretty similar. So we somehow know these unknowns already about the US politics, what's happening in the Middle East as well. This can have obviously some repercussions, but we cannot just guess what everything might happen. So it might be a shock on the growth side, it might be a shock on the inflation side with an exogenous inflation shock. So that would be a concern, of course, for equities and the fixed income side. As well, besides that, we are pretty positive on the macro context that we believe is still supportive for risk assets. So for this reason and in this environment, we are still invested. But just what refrains us for being invested a bit higher with high level is indeed this political context, plus some concern as well about valuation. So this is, let's say, quite a break on why we don't want to go for more.
Great stuff. Antoine, if you don't mind, I'm going to come back to you just because you mentioned valuations. I'm going to put you on the spot and ask, sort of within that context this year, obviously, we talked before once about sort of potential for increased volatility in the market. Obviously, we've had some blips, but to be honest, it's been a fairly upward trajectory, especially in US equities through most of 2024 to date. Obviously, with that comes fears of overconcentration and performance dispersion between sort of the winners and the losers. So it'd be good if I could hear a little bit from you on the sort of roles that market cap and sort of equal weight indices are sort of playing within your portfolios at the moment.
Okay, there are many questions here. Let's start with about the concentration risk, because it has been the big story first part of the year. So if you look at the first part of the year, most of the return from the S&P 500 was coming from these big tech companies. And afterwards, and this has been our thesis since mid of this year, we were and have been expecting some market rotation, especially in the equity markets. So what we saw basically here is some normalization and some changes in leadership. That is why we believe that this is one way to diversify away from these big techs don't get me wrong, it's not like that we don't like these companies and these big tech companies. However, at some point, we might see a recovery, especially when looking at earnings from the leftover, especially if we have now an economic cycle that is moving forward. So we might see some of these a sub-segment of the market recovering back. So ETF in this context can be used if you think of being diversified a bit away from these big tech companies. One side of the sentence is big, so you can get away from big market caps into small and mid caps. So here, obviously, you don't necessarily want to go with selecting your own small and mid caps. So ETF is a must here. Then you can, of course, diversify away from tech companies. And there are many ways using some ETFs. So you might be and want to be a bit more cyclical, looking at sectors, for example, and you might be willing to diversify always from the just US investment. So you can go a bit more regional in the asset allocation here.
Yeah, great stuff. Ivan, similar sort of question to you. How are you sort of using those sort of equal weight and market cap approaches alongside each other within your asset allocation, and how are you sort of viewing some of those potential over concentration risks at the moment?
Yes, exactly as Antoine. I think there's a trade-off between not being invested in those big tech companies and being too much invested in it. So that's why equal weight makes sense for the moment, and not only us, investment advisory, but the colleagues from the discussion portfolio management uses those kind of strategies now. And I think it is the good point for me, and I think where ETF can be really helpful in this context is where, it's in this environment where uncertainty is really the key word. We can, with ETF, with equal weight ETF or smart beta strategies, you can put those kind of strategies really quickly in place and take position in the market, and not especially spending time in doing due diligence for active funds, and especially where I work, where some kind of due diligence takes time, definitely. So that's with ETFs, we can quickly invest and take position in the market.
Yeah, great stuff. Gilles, I think the story this year has been one of not choosing between market cap and equal weight, but it seems to be the story of sort of blending the two. It'd be good to hear a little bit from you about sort of how clients are using both approaches. What kind of clients are using equal weight products, and sort of what sort of scale of uptake have you seen?
So we have seen quite a lot of uptake there. What we can already say is that all kinds of investors, whether it is on the advisory side, on the DPM side, from a private bank, but also insurances, pension funds, as well as other asset managers, have been considering equal weight as a solution. And what is more interesting as well is how rapidly they have been able to either switch into the broad S&P 500, for instance, and then back to the equal weight one, or just really having a very dynamic either factor or sector rotation approach. What do I mean by that? We have witnessed beginning of August this equity rout, where after this a lot of people had positioned themselves previously in the equal weights side, went back into the broad, and now as the US elections are coming closer, they are more concerned around dispersion, around concentration, and are slowly finding their way back into the equal weight scheme, just showing that this rotation that previously might have been just something on a quarterly, semi-annual basis can now happen more often as the products, as the methodology, as the indices are better understood, and the biases really explained in the market, and the information just available to all.
Yeah, great stuff. Antoine, outside of kind of the US equity picture, which has obviously dominated a lot of conversations within asset allocation this year, one of the sort of key debates of recent years has been about firms' approach to ESG. It'd be good to hear a little bit about how you're implementing your ESG approach through ETFs, sort of in light of those changing regulations and sort of those evolving sort of data and reporting standards that sort of coming down the line.
Yes, so as you know, we are not part of the European Union from this, where we are in Switzerland. So basically, we are not really, let's say, legally required to, to comply with the European Union taxonomy. However, it doesn't mean that we are not interested in the topic. So the way we approach on our side ESG is using available investments mostly. Because we believe that there are some asset managers that are really well equipped for that, and that we cannot match this kind of requirements. So what we try to do here is to work with the best on this front.
Yeah, great stuff. Ivan, I know your firm has its own ESG approach. It'd be good to hear sort of the role that ESG ETFs play within that, or don't play within that as well. And yeah, sort of how you're able to sort of marry sort of in-house kind of standards and sort of the products that's out there at the moment.
I like the word to marry. It's great. It shows exactly. No, I think there's especially in ETF. There are two worlds. The first world is we have a list of select indices where our ESG team just said those indices are ESG. So you can invest in it. And then, you get all the active ETF or special indices with the Paris aligned, those kind of stuff. That's where case by case, we must assess if we can invest or if those investments are ESG compliant for our ESG team or not. So that's where, that's to marry, we have to marry those two worlds. It's not easy, but it takes time. So I think it's because it's quite young, I can say that, but it more and more it will be easier to marry those two worlds in the future.
Great stuff. Gilles, is what you've heard so far kind of chiming what you've heard sort of from clients generally in terms of how they're sort of bringing together sort of their ESG approach and ETFs? It all sounds quite harmonious so far.
Well, it isn't really, right? Because everybody has their own ESG standards, will have different focuses on either E, S, or G, or within these three letters, really on climate, on other kinds of pollutions and so forth. So what we do see is this harmonization of ESG is still there to be done. There is no international standard. What we do see, however, and where we are looking positively into the future is that, for instance, here in Europe, with the ESMA renaming guidelines that will occupy quite a lot of time for asset managers and investors, there will be somewhat of a clearer picture what ESG has to be, with minimum requirements and an overall, let's say, a 360-degree view on ESG becoming clearer across Europe. And there, what we do believe is that we will have a bit of a consolidation in terms of methodologies, consolidation in terms of how ESG is being used, and consolidation in terms of who will be provider of such solutions.
Yeah, great stuff. Just coming back to you again there, Gilles. As we're sort of looking ahead, we've talked a little bit about the US equity picture, and obviously the world isn't just US equities. We should be quite clear on that. It'd be good to hear a little bit about how clients are using more selective strategies, moving away from that kind of broad market picture to sort of capture a slice of the market, and sort of how that's sort of made up of whether that's factor, sector, thematic, or active ETFs. It'd be good to hear a little bit about how clients are increasingly slicing the market.
Indeed. So this is what they're doing. On one side, they are playing a lot more themes than previously thought. So whether it is around AI or whether it is around sub-segments of the technological advances, there's a lot of more traction in these products than you would have seen 5 years ago, maybe. What we do see as well is a theme around how to play emerging markets, how to play developed markets. And here we have also seen an evolution of investors really going for solutions around excluding certain countries or creating a sub universe on the equity side in order to either focus on a specific country with something a little bit, let's call it funkier, and then just cover the rest of the market. For example, MSCI World X USA, or on the geopolitical side, maybe for other concerns or wanting to infuse a different accent on a specific country in the emerging markets, play something like emerging markets ex China, where we do see that due to the difficulties, the heterogenic nature of the Chinese equities market, that people are maybe focusing more on A shares over there instead of H shares, that they're focusing maybe on different universes than a broad one from MSCI China, for instance, really digging into just A shares. There is a combination of MSCI emerging markets ex China and a specific exposure to China, maybe even through an active asset manager, may make a lot of sense. And this is really something that has been quite of a novum for the past 18 months here in Europe.
Yeah, great stuff. Ivan, we good to hear a little bit about how Raiffeisen's sort of using those more selective ETF strategies, and whether that be through sort of like the factor sector theme or even the sort of active lens, which is increasingly sort of entering the mix.
So themes, as Gilles just said, we have a lot of interest in themes, ETF, for example, clean energy, smart food, smart city, all this kind of stuff. I think it's not really on volumes are not that high, to be honest, but it's more, I think it's more, in French we say the produit d'appel. It's more to show that we can bring something that is different, that is sexy, as Gilles just said, and that's how we use the themes ETF. Otherwise, I think we stay quite not that funky, but still active ETF are more and more in mind, my team and different teams within Raiffeisen. But it's wait and see. For the moment, we use that. We're using that minimum size, but I think it will grow months after months in coming years. In the coming years. Yeah.
Great stuff. And Antoine, lastly to you, good to hear a little bit about how CISA is using those more selective ETF strategies, sort of what role they play and why.
Yeah, so to come back on what you're saying, Gilles, as well on the equity side, so they can be used for looking at different segments of the market, and to benefit from the market rotation we see at the moment. So we might use some small and mid-cap ETF, some sector ETF. If you think about the US politics, there is maybe one sector that might benefit to both candidates in case of a sweep, which are the materials and infrastructures. So there are ways around. Gilles was mentioning as well. It's really interesting. I discovered that a month ago, basically, that there is indeed a global emerging market equity ETF ex China, which is quite a reversal of the story here. So this is one good way to do it. As well, in terms of the kind of style, depending on the style you want to look for on the equity side, we see as well some client interest that were initially interested in income, so mostly coming from the fixed income world, now looking coming into the equity world. Basically, we still have a preference for equities above fixed income, so we push in this direction. And we have some clients that want to still be invested with some high income payers, but on the equity side, meaning talking about the dividend, high dividend paying stocks. Of course, we use them on the other side with the fixed income part. So it's a good way, this ETF, a good way to implement a views. What we say our client is not to miss the train on the income and on the yields. Our view is that we are going to see some rate cuts. In this context, you don't have to be too short, otherwise it's not going to last. So you need to extend a bit the duration. Some of them might be a bit reluctant to go too long and to be active. So here, fixed maturity can be a good one. And we don't want to be too long as well, because we might see some impact, especially after the political events. So we are a bit more cautious on the longer part here.
Great stuff. It's been really interesting diving very briefly into sort of how we're using ETFs and sort of a bit about the outlook for the future, but I'm afraid that's all we've got time for in today's conversation. Thank you very much to today's speakers, and do join us again next time. Thank you for listening. All the best.
Bye-bye.
Take care.
Cheers. Bye.
Thank you very much. Thank you. Bye-bye.